Okay, so you have to think about the two things that with oil and gas is that there is private companies like ours, and there are public listed companies. So public listed companies, okay, are obviously traded on the open market, and investors will invest into their companies. And of course, they'll use a proportion of that to drill for new wells. Or you get private equity companies that have a certain amount of money. They might have an energy fund or a certain amount of exposure to oil and gas. They put money into these public listed companies or into large private companies, maybe, for example, like Providence Energy, you know, like the UPS fund put money into Providence Energy. And that's how they do their drilling. So why are there less rigs drilling for oil when the oil prices are going through the roof? So let me explain this for you now. So let me get into the next slide. So let me just go into share screen. We're already there. Sweet. I'm going to come back to here. Okay, so the next slide. So this is the S&P 500. As you know, it's the top 500 stocks in the US. You can see if you put $100 or $100,000 into the market, you could see the energy stocks and the S&P was almost perfectly correlated. In some cases, there was a bit of an increase in your return. Now, come to around about 2014, that's when the rig count dropped off. You can see there's been less money put into the energy stocks. And you can see a massive disproportionate growth between S&P 500 and the energy stocks. Now, why is that happening? It's because most of these oil and gas companies, most of these public listed companies are getting more pressure from shareholders to go into renewable and clean energy. So the amount of money, for example, BP would put in, say, 5 years ago into new drilling programs compared to now, I wouldn't say it's half, but I know for a fact it's a huge, sizable difference in what they're actually investing compared to 5 or 6 years ago. So there's another great little chart here, which is basically the private equity company. So private equity, obviously there's a fund, you have what's called mixed energy funds. So they, generally speaking, have a mix between oil and gas and coal and also renewables. The black shows you oil and gas and coal, green is renewables, okay? And obviously the gray is mixed. You can see here that mixed is low, green, and obviously oil and gas is high. And then as we've been getting through, you can see there's been a deduction and then a bit of a rise. And of course, look at the difference here. 80% of all funds are going into renewable and into clean energy. Now, we cannot live without oil and gas. There's going to be another 20 years of transitioning. So it's the small companies like Alpha 7 Energy that do need to keep producing oil, because if we turned off oil today, there would be anarchy. So there has to be some companies, and it's the small, nimble companies like ours, that are actually keeping the oil production, and we're increasing that production. And of course, there is going to be a huge profit margin for our investors and ourselves. So that's what I'm really excited about. So there was something called peak oil. People were saying that because of COVID-19, we're going to hit peak oil. Demand is going to be lower every year. Well, let me show you one of the last slides of the day, and you will actually see. Now, there's a government agency. It's called the Energy Information Agency. It's a US-based government agency. And you can see here, there's been a steady increase in the demand for oil. Of course, through COVID, there was a decrease. We know that. People weren't traveling. People were staying at home. 2021, there's been a bit of a global recovery, especially in the States. But they're actually projecting an increase in oil demand that, if you actually look here, is higher than the highest year in the last 12 years. Now, also as well, is that on the 4th of July this year, there was 10 million gallons of gasoline purchased in one day, and is one of the highest on record in a single day. And the last time they hit that was back in 1990. So that was about 31 years ago. I was probably, I was still at school then. That's how long ago it was. So we've spoke about what, we spoke about why, and now I want to basically explain the opportunity how this can benefit you, because at the end of the day, everything's about timing. There's a good time to get into markets, there's a good time to get out of markets. And of course, oil and gas at the moment are at some of the highest. You would even say, for example, we might be at the top of the cycle. I would agree upon that fact, and our experts and experts globally, yet we are not drilling the same amount of wells. So at the end of the day, there's a decline curve. So every year there's less oil in the ground from these wells. So do you keep consistency of production? You've got to keep on drilling more wells. And there are less wells being drilled. And I'll just show you this very quickly just to finish off here. So if we go back onto here. So as you can see here, there was a huge run up. So you can see between say 2009 and 2013, 14, so let's say 5-year period, we were seeing oil around about $83, $84 a barrel, all the way up to 115. And then it sort of stabilized around about the $100 to $95. Most experts are seeing that we're going to get up to $90 a barrel by the end of the year. And there's a high potential that we're going to see over $100 WTI in 2022. So that is very exciting indeed to know that we have the opportunity to really capitalize on the growth and the demand factor and the supply. And because all these oil and gas companies, they're going into renewables, we still have to produce oil. So what does that mean for our investors? It means that our operating costs stay the same, yet our profit margins increase exponentially. And most experts are seeing that in the next 1 to 5 years that we're going to be seeing prices ranging from say 85 all the way up to 110. And there was 3 different scenarios for oil and gas, and we're actually tracking towards the high case scenario, which is showing a potentiality of $190 per barrel. So obviously it's going to cost a lot of money to fill up your car. But on the other hand, if you've got direct oil and gas ownership, obviously it's going to be something that's going to be a huge benefit for you. So I just wanted to spend a little bit of time and basically just say to people, well, there is opportunity in the oil and gas industry. There is a demand for this commodity. And of course, we as a company give investors the pathway and the opportunity to be able to access these direct oil and gas projects, and we manage it for them. So if you are already an investor, you obviously be very excited because we have been pretty consistent with our updates with our investors. Investors know what's happening in the marketplace and where the market is potentially going to. If you're an investor that's interested in knowing more, you're able to reach out to myself or to Dylan Knight, and we're more than happy to educate potential investors on the benefits and the foreseeable future of oil and gas. So my name was Grant McLoughlin. Really appreciate your time, and speak to you soon. Bye-bye.